Welcome to the Consumer Financial Protection Bureau's field hearing in Milwaukee, Wisconsin at the Wisconsin Center. At today's field hearing, you will hear from Director Richard Cordray, Deputy Director Steve Antonakis, Undersecretary of the U.S. Department of Education Ted Mitchell, and a panel of distinguished experts who will discuss student loan servicing issues. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Zixta Martinez. I'm the Associate Director for the External Affairs Division at the CFPB. Our audience today includes consumer advocates, industry representatives, state and local officials, and of course, consumers. We are especially pleased to have in the audience David Mancy of the Wisconsin Department of Financial Institutions. Let me spend just a few minutes telling you about what you can expect at today's field hearing. First, you'll hear from Ted Mitchell, Undersecretary of Education, after which you'll hear from CFPB Director Cordray, who will provide remarks about student loan servicing and the RFI, which we published today. Following the director's remarks, Deputy Director Steve Antonakis will frame a panel discussion about student loan servicing. After the discussion, there will be an opportunity to hear comments from members of the public. Today's field hearing is being live streamed at consumerfinance.gov. You can follow CFPB on Facebook and Twitter, and you can also follow today's conversation using hashtag #StudentDebtStress. So let's get started. Ted Mitchell is the Undersecretary of Education at the U.S. Department of Education. He has served in this post since his confirmation on May 8, 2014. Undersecretary Mitchell oversees policies, programs, and activities related to post-secondary education, adult, career and technical education, federal student aid, 5 White House initiatives, as well as the Center for Faith-Based and Neighborhood Partnerships. Undersecretary Mitchell.
Thank you very much, and welcome everyone. Happy to see you all here and look forward to our conversation today. Director Cordray, thanks for inviting me to be a part of this. I really am quite happy to be here because for 2 reasons. I'll get to both in a moment, but I want to say overall this is a very important moment for us to have this conversation. It's important in the history of the nation, it's important in the history of the industry, and it's certainly important in the history of the government and in the lives of students. Over the last few years, the Obama administration has really focused on making college more accessible, more affordable, yielding higher quality outcomes for a broader range of students than we ever have before. And we believe that the administration has succeeded in helping more Americans get to and through college and to help them manage debt. On the front end, I think you know that the administration has led the way in expanding Pell Grants to students. It's been particularly important in the face of state disinvestment in higher education, including right here in Wisconsin. We've worked with many of you in the room to simplify FAFSA and have more work to do there. We've expanded the American Opportunity Tax Credits. We've created more information tools for students and families and institutions. And finally, and most recently, the President has announced in the State of the Union his intention to make 2 years of community college free to all Americans, which we believe will be a major marker in setting a conversation about increasing what we think of in America as universal publicly supported education from the 20th century notion of K-12 to the 21st century notion of pre-K through community college. We've also tried on the back end to help students and their families pay for college. We've expanded public service loan forgiveness programs. We have built out income-driven repayment plans, including last week, completing the puzzle around pay-as-you-earn so that every American borrower now has access to income-driven repayment plans. And then in real time, we've been working with several of you in the room to create a clear roadmap toward borrower relief in cases where borrowers have been defrauded or where colleges have misrepresented themselves. College continues to be the very best investment that an individual can make, that a family can make, and we believe that a nation can make in its collective future. We need to do all we can to contain costs, and we need to do all that we can to help students afford the debt that they developed in moving through college. But the reality is that student debt is growing and is creating real and perceived barriers to students and families, barriers that stand between them and their dreams and us and our shared dreams for the nation. With the move to direct lending in response to the financial crisis, the department in 2009 contracted with a group of existing loan servicers to provide guidance and advice to borrowers. Since then, we have worked with those servicers to improve service and to improve the effectiveness of the servicing program. This year, and this is one of the important points about having this conversation now, this year we will be recompeting the contracts for loan servicing. And in anticipation of that, Secretary Duncan has charged my office to explore the borrower experience from front to back. And it's that work that's been ongoing that makes it so exciting today to acknowledge CFPB's entry into this work with this bold initiative. I'm here to learn and listen, but I'm also here to signal the deep partnership that the Department of Education has with CFPB on this and so many other issues. With the tools we have in place, particularly income-driven repayment plans, we should all be aiming at a zero default rate among student loan borrowers. These are things we need to do together. The department and the administration have plenty to do. We need to work with the Department of the Treasury to make IRS data automatically available to income-based repayment borrowers to help them not have to recertify their loans and their income every year. We know we have to create better online tools for students to understand the totality of their loan portfolio and opportunities to lower their payments. And we need to execute on our commitment to create an integrated complaint system in the Department for student loan borrowers. This is not just stuff we want to do. This is stuff that the President has committed us to do in his presidential memorandum encompassing a borrower bill of rights. And we're working every day to bring about the changes we need to make. But much of the heavy lifting, the advice, the support, helping borrowers navigate their options, will continue to be done by servicers. We need to be sure that the servicers' incentives align with the goal of zero default, and we need to be sure to set high and definitive performance standards, and then hold our servicers to those standards. That's the work we hope you'll help us with today, and that's the work we look forward to doing together. Thank you very much.
Thank you, Undersecretary Mitchell. I'm now pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, he led the CFPB's enforcement office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Zixta, and welcome all of you. Thanks for joining us today in Milwaukee. I want to say a special word about Undersecretary Mitchell, his team at the Department of Education, and the Secretary of Education, Arne Duncan, who's come to be a personal friend and a great leader for this country, very steadfast and devoted to the work being done. And it's challenging work. I mean, if you stop and think about it, they're trying to govern and direct a system of education, higher education in this country, and K through 12, but focusing only on higher education that really amounts to 50 state public systems, an array, a huge array of private colleges and universities, community colleges, trade schools, vocational schools, professional education forums in a variety of venues, and to do that with a system that in the United States of America is unlike anything in the history of the world in terms of providing broad access to all segments of our society, and trying to do that in an affordable way and a sustainable way is a worthy piece of work for anyone to undertake. And we have appreciated our opportunities to work with the Department of Education, partner with them on a variety of issues, call attention to the issues affecting consumers in particular, which is our focus, and it continues to be a very productive partnership, and that's because of the attitude and disposition of the people leading that effort at the Department of Education and our own people. And I want to especially acknowledge our really outstanding team, Office of Students at the Bureau, led by our Student Loan Ombudsman, which is a statutory position, Rohit Chopra, who is a truly outstanding public servant, and I've seen many in my day. So to come back to my prepared remarks, Plato once said, well, you know when I'm quoting Plato, I'm back to a prepared set of remarks, "The direction in which education starts a man will determine his future life." More Americans are heeding that advice and going to college at record rates, including both women and men, I might add, unlike in Plato's day. At the same time, the high price of college has created pressure and anxiety for students and families across the country, as we see so often in our work today. The Consumer Financial Protection Bureau is here in Wisconsin to focus on how tens of millions of Americans are affected by their student debt load, which in the aggregate now tops $1.2 trillion. Wisconsin alone has about 812,000 federal student loan borrowers, close to 1 million borrowers who owe $18.2 billion. This does not even include the expensive private student loans that many Wisconsin students most likely had to take out to get through school. This is a significant burden now being carried by many of our best and brightest. Student loans are now the largest source of consumer debt outside of mortgages. 2/3 of graduates are finishing their bachelor degrees with debt that averages nearly $30,000. Among the most careful observers of economic data, there's a growing consensus that a strain of this magnitude can have repercussions that threaten the economic security of young Americans and economic growth for all Americans. Significant debt can have a domino effect on the major choices people make in their lives, whether to take a particular job or not, whether to move or not, whether to buy a home or increasingly not, even whether to get married. 2 years ago, we issued a public notice and held a hearing to gather input on the student debt domino effect. We received more than 28,000 responses. This really struck a chord with people. The responses identified areas of concern, including an overwhelming feeling by many borrowers that the process of paying back their loans creates harms of its own and should be improved. They said the frustrations and difficulties of understanding when, where, and how to pay back student debt are stressful and counterproductive. Today, we're going to be focusing very specifically on these issues. Borrowers who finance a home, a car, or an education often find that a company they never heard of acts as their loan servicer with the responsibility on an ongoing basis to collect and allocate the loan payments. That is, in fact, their relationship over time. For young people finishing college, student loan servicers will be their primary point of contact on their outstanding loans. These companies are responsible for collecting payments and sending the payments to the loan holders. Borrowers rely on them to process payments accurately, to provide billing information, and to answer questions about their accounts, including ways to help prevent default. The servicer is often different from the lender. People often are confused about this. This means consumers often have no control or choice over the company they're dealing with to manage their loans. As a growing share of student loan borrowers reach out to their servicers for help, the problems they encounter bear an uncanny resemblance to the situation we have seen very close up, where struggling homeowners reached out to their mortgage servicers before, during, and after the financial crisis. Having seen the improper and unnecessary foreclosures experienced by many homeowners, the Consumer Bureau is concerned that inadequate servicing is also contributing to America's growing student loan default problem. At this point, about 8 million Americans are in default on more than $100 billion in outstanding student loan balances. Today, we're launching a public inquiry into student loan servicing practices. The inquiry seeks information on the hurdles that make repayment a stressful process and even at times a harmful one. For many young people, repaying a student loan is one of their first experiences in the financial marketplace, first significant experiences. Starting off their financial lives with such a big debt load can feel overwhelming, and it can become all the more stressful when things do not go right. Defaulting on a student loan can be devastating. Nobody wants to start out in life that way, making it harder for a young person to gain a firm financial footing. The resulting pressures can make student loan borrowers feel like they're walking a tightrope where any false move can cause them to fall. The request for information that the Consumer Bureau is issuing today is meant to find ways to put the service back into student loan servicing market and help people avoid unnecessary defaults. We're encouraging student borrowers to share their experiences by visiting consumerfinance.gov. To spread word of this initiative online, use the hashtag #StudentDebtStress. At every stage of the process of paying back their student loans, borrowers have told us they're wrapped in mounds of red tape, particularly for private student loans. From the beginning, when they first graduate and start making their initial payments, consumers can experience problems with payment posting, problems with attempted prepayments, and problems with partial rather than full payments. For example, some former students have told us they find it takes a few days for servicers to process their payments, which can cause them to have to pay additional interest. We've also heard from borrowers who complain about inconsistency, noting that they often get widely different information, protections, and rights, depending on what type of loan they have. When borrowers do seek any sort of help, the range and severity of their problems can quickly snowball. They've told us about lost paperwork, unanswered inquiries, and no clear path to get answers. They also find that when errors are made, they may not be fixed very quickly. They may encounter limited access to basic account information, including their payment history over the years. One borrower told us, for example, that she made her payment on time and in full each month through an automatic payment system established by the lender, but still faced problems with unexpected fees. Once again, these kinds of problems are not new to loan servicing in general, and in particular, they've happened repeatedly in the mortgage servicing market over the past decade. The stress can get even worse when loans change hands from one servicer to another. Transfers are very common in this market, and the consumer has no control over it. Between 2010 and 2013, more than 10 million student loan borrowers had their loans moved from one servicer to another for various reasons other than consumer preference. One person told us that after 7 years, her account was switched to another company. Suddenly, she stopped receiving paper statements and since then has had to call the new servicer each month to confirm her payment amount and that it was made. These loan transfers can produce real headaches and confusion for consumers. Some borrowers have complained that they're charged late fees because they mailed their payments to their old servicers without being aware that this was now an error. Other types of problems can arise as well. We heard from one person who said he made full payments each month for 6 years. But when he informed the new company handling his loan that he wished to enroll in an alternative payment plan that had always been available from his original servicer, he was told that was no longer an option. In today's request for information, we're seeking greater understanding of industry practices and the underlying market forces that are causing various pain points for borrowers. The inquiry seeks to determine if the student loan servicing industry is doing things that make repayment more complicated and more costly for consumers. We're interested to know whether payments are applied in ways that maximize fees or lengthen the amount of time for repayment. And we also want to know whether servicers are forwarding enough information to the new company when the rights to a loan are sold. We also intend to get a deeper understanding of whether there are, in fact, as some would claim, economic incentives for inadequate service. Because student loan borrowers generally do not get to choose the company that handles their loans, that's just a very important feature of this market, which is why we're emphasizing it. Ordinary market forces will not guarantee reasonable customer care. The model used in most third-party loan servicing contracts for students provides companies with a flat monthly fee for each account. This fee is generally fixed and does not rise or fall depending on the level of attention that a particular borrower requires in a given month. This means that student loan servicers often make more money when they spend as little time as possible on each account, and they typically get paid more when a borrower is in repayment longer. So we're evaluating whether the typical methods of servicer compensation can jeopardize the interests of borrowers. We especially want to know if there are adequate economic incentives to take the time to enroll people in flexible repayment options or help them avoid default. We also are interested in seeing what we can learn from protections offered in other consumer credit markets. Protections offered to consumers with credit cards and mortgages might help improve the quality of student loan servicing as well. In recent years, policymakers have adopted broad-based changes to strengthen federal consumer financial laws so that they better protect consumers with mortgages and credit cards. But there's currently no comprehensive statutory or regulatory framework that provides uniform standards for the servicing of all student loans. This means servicers in other markets are subject to more precise rules that include customer service standards, limits on certain fees, written acknowledgement of disputes, and protections when loans are sold. In some cases, servicers are required to explain the options that are available to distressed borrowers. For example, a mortgage servicer, under new rules of the Bureau, must consider all foreclosure alternatives available and cannot steer homeowners to those options that are most financially favorable to the servicer. And so we're deeply interested to learn more about whether recent reforms in the credit card and mortgage servicing markets might help improve performance in the student loan servicing market. After all, loan servicing generally includes many common functions, irrespective of the underlying consumer financial product, such as account maintenance, billing and payment processing, customer service, and managing accounts for customers experiencing financial distress. Some of these comparisons may be quite specific. For example, credit card users have had certain protections under the Card Act since 2009. Consumers get timely posting of their payments and periodic billing statements at least 21 days before payment is due. If a consumer has multiple balances at multiple interest rates, any extra payments generally must be allocated to balances with the highest interest rate so borrowers can get out of debt as quickly as possible. We're seeking information on whether applying these same approaches might benefit student loan borrowers as well. In the same vein, the Bureau is seeking information on whether the reforms we recently made to the mortgage servicing market through new regulations might also benefit student loan borrowers. Reforms related to payment handling, loan transfers, error resolution, interest rate adjustment notifications, loan counseling, and treatment of distressed borrowers are all now in place to improve the functioning of the mortgage servicing market. We're analyzing whether these protections should inform policymakers and market participants when considering improvements in student loan servicing as well. Furthermore, the lack of transparency of the student loan market remains deeply problematic. Both the financial regulators and the public lack access to basic fundamental data on student loan origination and performance. Without this information, we will be challenged to understand the complete set of risks posed by student debt burdens. Today's request for information asks whether more can be done on this issue and what, in fact, should be done. At the Consumer Bureau, our mission is to provide even-handed oversight of industry while promoting fair and transparent markets. For this reason, we finalized a rule that will allow us to supervise larger non-bank student loan servicers, thereby closing a significant gap in oversight for compliance with federal consumer financial laws. So the landscape is already changing. We're also grateful to our partners at the Departments of Education and Treasury and among the state attorneys general for their work to protect student loan borrowers. As our country pursues a vigorous debate about higher education policy, it's imperative that we keep in mind the very real challenges of those who have already accrued substantial student loan debt. We must do more on their behalf. Student loans play a pivotal role in young people's lives as they seek to establish their credit worthiness and eventually finance their first major purchases. And with more than 40 million Americans now carrying substantial student debt loads, it's simply unacceptable to leave them without robust consumer protections and a well-functioning servicer market. Abigail Adams once said, "Learning is not attained by chance. It must be sought for with ardor and diligence." In today's world, her statement applies not only to how we should seek to educate ourselves, but also to how we should seek to provide financing that makes educational opportunity possible. The rights of consumers to be treated fairly and according to the law must likewise be pursued with ardor and diligence, and we intend to do that. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite our guest panelists to please take the stage. And while they're doing so, I will briefly introduce CFPB and guest panelists. Steve Antonakis serves as the Deputy Director, as well as the Associate Director for Supervision, Enforcement, and Fair Lending at the CFPB. He is responsible for the supervision of all banks and non-banks under the CFPB's jurisdiction and the enforcement of federal consumer protection and fair lending laws. We also have with us Rohit Chopra, Assistant Director for the Bureau's Office of Students and the Bureau's Student Loan Ombudsman. Our guest panelists are Jen Wang, Policy Director, Young Invincibles, Timothy Fitzgibbon, Senior Vice President, National Council of Higher Education Resources, Deanne Lunan, Student Loan Borrower Assistance Project Director, National Consumer Law Center, Justin Draeger, President and CEO, National Association of Student Financial Aid Administrators, Dick George, President and CEO, Great Lakes Higher Education Corporation, Chuck Neffley, Director of Financial Aid, Clemson University, and of course, Undersecretary Ted Mitchell. Steve, you have the floor.
Great. Thank you, and good morning, everyone. My name is Steve Antonakis. I serve as the Deputy Director at the Bureau. It's a pleasure to be with you today and to facilitate this portion of our field hearing on student loan servicing. We'll hear from a number of respected panelists today, including consumer advocates, financial aid administrators, and representatives from the student loan industry. Each panelist will make brief opening remarks, and then we'll begin the discussion. After that, we will conduct the public testimony component of the hearing, where audience members who have signed up will have an opportunity to make a comment. Before we begin the panel discussion, let me note that you can examine the complete request for information that the director just described, as well as instructions for how to submit an official comment by visiting our website at www.consumerfinance.gov. Again, www.consumerfinance.gov. Now, our panelists will discuss the best practices, concerns, and innovations in the student loan servicing market. Each panelist will have 2 minutes to make a brief statement. Let's begin with Justin Draeger.
Good morning, and thank you for the invitation to be here today. From the National Association of Student Financial Aid Administrators, or NASFA, we represent 3,000 colleges and universities across the country. Our members serve 9 out of 10 undergraduates attending college in the United States. And the financial aid administrators in particular have a vested interest in participating in this conversation. Schools, besides altruistically, and the financial aid administrators altruistically wanting to help borrowers, have very few resources currently to prohibit or stop people from borrowing loans or curb their borrowing. Schools are prohibited from getting in between a borrower and what are considered entitlement dollars, federal student loans. Even though they can't stop students from borrowing or over-borrowing, they can provide voluntary counseling, mandatory counseling up front, and then continued voluntary counseling along the way. And for some students who find themselves in trouble down the road, it's often the schools who serve as advocates for them, trying to navigate a very complex repayment environment, as has already been pointed out by Director Cordray. In addition, schools have a vested stake in making sure that students stay current on their loans after they leave college, since schools can lose Title IV eligibility for other students that are attending at their institution if their default rates, the number of students defaulting on their loans, goes too high. So it's for those reasons that we reached out to institutions across the country and asked them to tell us through a survey what could be done better. And we've published those survey results on our website in a report this last winter that talked about all the different processes that could be improved. I want to hit on just a couple and wrap up. Of those who responded to the survey that deal with students and their loans, half said that the repayment plans are just too complicated for students to navigate. They also cited inconsistencies between servicers in how they handle student loans, deferment and forbearance options, and how repayment plans were explained to students. It varied based on servicer. From a school standpoint, one of the major issues was it was difficult for the student to help it was difficult for a school to help a student navigate this process if they didn't understand the various differences between the servicers. And for that reason, we are calling on some sort of common manual or policies and procedures tool that would outline how different servicers handle different loan interactions so that they could clearly see this servicer handles repayment plans this way, this servicer handles interest capitalization this way, this servicer handles documentation for income-driven repayments this way. This doesn't exist right now, and it's a patchwork of effort on behalf of many schools to try to put this together. Thank you.
Great, thank you, Justin. Next, we'll hear from Timothy Fitzgibbon, Senior Vice President for the National Council of Higher Education Resources.
Thank you. Thank you for the opportunity to participate today. This morning, both Director Cordray and Secretary Mitchell talked about unnecessary defaults, and we believe that communication is the key to addressing some of those, and so that's what my remarks will have to do with this morning. What we believe borrowers need centers on providing personal communication, personal conversations, and not websites, not collection letters, real person-to-person conversations. But we have to overcome unnecessary technical barriers that are blocking these conversations between the borrower and the service provider. Barriers that are based on grossly outdated rules on the use of communications technology to reach consumers on their cellular telephones. Timely and effective communications about flexible and affordable repayment options. These are the keys to better service, fewer defaults, and fewer borrowers languishing in default. The repayment programs, as Justin said, are complicated. And even if simplified by Congress, students, borrowers, and families need conversations to understand their options. The number one action the Bureau can take to help student borrowers, the number one thing, is to push for modernizing the rules that implement the Telephone Consumer Protection Act. Now, this has nothing to do with telemarketers bothering us at dinner time. It has nothing to do with collection agencies making harassing phone calls. It has everything to do with helping literally millions of borrowers get out of default or avoid default altogether by making it easier for servicers to speak with consumers and offer individualized solutions. Consumers who, by the way, almost exclusively use cell phones. We no longer have the luxury of continuing to debate this issue or kicking the can down the road. Tens of thousands of student loan borrowers are timing out needlessly defaulting on their loans every month. Tens of thousands are timing out and defaulting every month. And countless more languish in default simply because outdated rules governing auto dialers and cell phones keep servicers from reaching borrowers in time or from reaching them at all. NSHARE and its members look forward to working with Congress, the FCC, and the Bureau to develop reasonable rules combined with important consumer protections that will allow the use of 21st century technology to communicate with student loan borrowers. Thank you.
Great. Thank you, Timothy. Next, we'll hear from Dick George, President and CEO of Great Lakes Higher Education Corp.
Thanks very much for the opportunity to be here today and to share thoughts with you on these critically important issues. Great Lakes Affiliated Group is one of the largest servicers in the student loan space. We service some $200 billion in student loans for nearly 9 million borrowers all across the country, some 2,000 employees. We are a little bit unique in the sense that we are, at our parent corporation level, a 501c3 nonprofit charity. Our principal mission is post-secondary access and success. And so everything that we do as a servicer is actually guided by that mission of post-secondary access and success. And when we look at our role as a servicer and we look at the current media coverage of the student loan debt crisis, we have a little bit different perspective as an operational entity than what we see as the principal focus of that media coverage. And that is that there's a great deal of concern with providing relief for overburdened graduates. And in our view, the focus really needs to be on a different cohort of borrowers. And it's the cohort not who have graduated and borrowed too much, but the cohort who have borrowed too little because they failed at post-secondary education. That cohort, which is predominantly comprised of low-income, minority, and first-generation borrowers, it's almost 80 to 85% of our delinquency and default portfolio. And unfortunately, when students drop out, they also tend to drop out of communication and become skips, both address and telephone, which means that all of the tools and instruments that we have in deferment, forbearance, alternative repayment methodologies, loan forgiveness, all of those things that we could normally bring to bear to cure any delinquency and default. And as Secretary Mitchell has said, we should all be striving to zero default rate. It is perfectly conceivable that we would get there. But we can't do that if we can't communicate with that vulnerable cohort of dropouts. And we really need to work together to figure out how we can increase our level of communication with those most vulnerable populations. That is probably the most difficult aspect we face as a servicer, and I think it's the most difficult aspect that the program itself faces going forward, and one that we very much want to work with the CFPB and the Department of Education in addressing. The program is increasingly complex. The numbers of repayment alternatives, the numbers of loan forgiveness and deferment and forbearance alternatives is extremely complex. But again, none of that can be brought to bear on behalf of that most vulnerable cohort of dropouts unless we can actually find a way to communicate with them early on. That might be the most important thing we can do in the servicing environment. Thank you.
Great. Thank you, Dick. Next, we'll hear from Chuck Neffley, the Director of Financial Aid at Clemson University.
Thank you very much. I appreciate the willingness or the willingness on your part to hear from us. And I bring two perspectives today. One is a practicing financial aid director at a large public school. But also, I currently serve as the chair of the National Direct Student Loan Coalition, a group of practicing financial aid administrators at direct loan schools. And I want to tell you a little bit about the evolution of direct loans over the last 20 years. Of course, we're in, I think, our 21st year of the existence of direct loans. And when it started, it was a school's choice whether you went into the direct lending program or the bank-based FFEL program. And of course, in 2010, we moved to 100% direct lending. And the way that I've talked about it with my colleagues around the country is we ended up with about 2/3 of the old direct lending program. And I'll explain that a little bit. First of all, the first part of lending is the origination and the borrower application process. And that has taken on the front end of what direct lending looks like. So the schools work with one entity to originate a loan and then give that to the student. The second part is while the student's in school, and that gives the school an opportunity. If the student asks, I want to raise my loan, I want to take less, I have questions about it, disperse it to pay my bill, again, that's all handled at the school level in conjunction with Department of Education. What has changed is the back end, the servicing end. And there are some good things about the change, and there are some bad things about the change. The good is that we now have some redundancy in the servicing environment, which is excellent. So under the old direct lending program, we have one servicer. And although the servicing was very good, there was one. If there was an issue with that one servicer, of course, we would have issues. So the redundancy of servicing and keeping that servicing out in the private community with contractor works fine. The big change has been is that the identity of that servicer is now known to the student, and in fact, it is marketed to the student. If you look at the old direct lending prior to the switch to the new servicing model, the default rates for students in direct lending year after year were consistently better than those in the bank-based lending, and that makes a lot of sense. They were dealing with one entity on the back end, and the Department of Ed was dealing with one servicer. Currently, the student sometimes might not even know that the information coming from the servicer is about their federal loan. They think, I'm taking out a loan with the Department of Education. The schools tell them, you're taking out a loan with the Department of Education. Yet the communication with the student comes from one of our 11, 12, 13, however many different direct loan servicers we have right now. So I personally call for, and so does the, and representing the Direct Loan Coalition, that there's just no need for the student to have to know who their servicer is. We have the technology, we have everything in place where the communication can be from the Department of Ed, and that can be serviced by as many servicers as makes sense. But we consistently hear from students, and Justin alluded to this in his comments earlier, that they don't know who their servicer is, or they're receiving information from the servicers, and much of it is very good. My daughter has a direct loan, and the information she receives is very good. But it's not clear that that is a Department of Education, a federal loan, and we think a lot of students are disregarding that communication because they don't realize that it's back to their federal loan, and that is contributing to the excessive default rate that we have right now. Thank you.
Great. Thank you, Chuck. Next, we'll hear from Deanne Lunan, Student Loan Borrower Assistance Project Director at the National Consumer Law Center. Deanne.
Thank you, and thanks to Director Cordray and Undersecretary Mitchell, too, and CFPB for inviting us here, or me here, to speak today, and for your commitment to market-wide reform in the student loan industry and prioritizing borrower needs. I'm here today on behalf of my low-income clients. And one thing I just want to sort of state from the outset, one thing about the demographics of our clients and all student loan borrowers really is that even though a lot of them are young, and we hear a lot of talk about young people, the demographic is much broader, all ages, basically all income levels, class, race. And even if they start out young, they may not be young throughout the servicing and collection process, because on the federal loan side, as many of you know quite extraordinarily, there is no statute of limitations on collection, and so literally these really can last a lifetime. On the private loan side, it's also important to note we're seeing a lot more practices with shady debt buyers and other ways in which, even though there is a stated time limit, the loans may be kept alive even when they shouldn't be kept alive. And in many cases, those are predatory loans from the past. With respect to servicing, servicing really is the lifeline for our clients and others like them. It's the borrower's primary point of contact. And if done well, it really is one of the main ways to help prevent borrowers from defaulting. And unfortunately, what we see is that it's often not done very well. And I just want to focus particularly on what we're looking for is comprehensive, unbiased counseling for borrowers. So that, for example, on the federal side, people have rights that they're entitled to. There's an array of relief programs. What we want to see is that people get objective counseling about the full range of rights. What we often see instead is counseling based on servicer convenience, or in some cases, unfortunately, servicer incompetency, or misaligned incentives. Same thing on the private loan side, even though there aren't as many mandatory options. Again, we're looking for a system that is working toward what's optimal for borrowers, not necessarily what's optimal for the servicers, and Director Cordray alluded to some of those same problems that had occurred in the mortgage market, and still are occurring to some extent. So we're really pleased to see that the steps that CFPB has taken today. I want to make sure that we urge that we emphasize the urgency of what's going on now, that there's a need for clear, transparent, and privately enforceable borrower standards, just like there are to some extent in other consumer credit areas. Some of this might take some new rulemaking, and we urge the agencies to work together on that, but that we don't want to wait for that either, that there's existing tools, there's existing authority, both in terms of being able to set standards, whether it's through the department's contracts, whether it's through existing state and federal authority, but that while we're looking to the future, that we're also acting now, because people like our clients are suffering now and really need help now. And this really is, if servicing's done well, this is a way to give people for whom school might not have worked out the first time around, it's really their best chance at a fresh start to go back to school, enter repayment, and hopefully get into the labor force as well.
Great. Thank you, Deanne. We'll round out our opening comments with Jen Wang, the Policy Director of Young Invincibles. Jen?
Thank you so much, and thank you so much for everyone who's here in the room, and to CFPB and the Department of Education for doing this important work on behalf of student loan borrowers. I'm the Policy Director at Young Invincibles, a national nonprofit dedicated to elevating the millennial experience on key economic issues affecting their lives. I'm here today to share with you the results of a very recent survey on student loan servicing that we conducted over the past 2 months. Student loan servicers, as many of you know, are companies that manage student loans when they're in repayment. For folks with federal loans, the Department of Education lends out the loan, but a separate company services the loan. And so many borrowers, like Deanne mentioned, will interact with their servicer for years, even decades. And this is why we want to ensure that borrowers, particularly those who did not complete their education or those who start out having trouble starting their career, have the most consumer-friendly experience as possible. We received 1,230 survey responses about borrower experiences with their student loan servicer. Our respondents are part of a self-selecting sample, those with student loans who are having their loans serviced, and many of these borrowers have a high level of concern, if not distress. 39% of them told us that they have contacted their student loan servicer and were not able to reach a positive outcome. One borrower shared her story. I contacted my servicer about putting my account on forbearance due to unemployment. Little did I know I was never put on forbearance, and eventually my account defaulted. 54% told us that they felt that their servicer made it more difficult to repay their student loans. A borrower wrote, "My servicer did not accurately display federal repayment plans that I was eligible for." 38% felt that they do not receive timely and accurate responses from their servicers. 82% said that they've had their servicer change. And of those who experienced a servicer change, 32% experienced problems repaying their loans as a result of that change. One borrower said, "When my loan servicer changed, my loan balance appeared as 0 for months. I attempted several times to get an answer, to no avail. I then got a nasty letter in the mail demanding back payments, which had never previously been billed to me." 15% sent instructions to their servicer with a payment, like asking a servicer to apply the payment to the highest interest loan. And those instructions were not followed. Another borrower said, "On multiple occasions, I've sent letters plainly detailing how I would like extra payments applied. These letters were ignored, and my servicer applied the payments as they saw fit." So we feel that we have multiple reasons to be concerned for borrowers and their experiences while they're in repayment. I hope that these stories and experiences shape today's conversation.
Great, thank you, Jen. And let me thank all of our panelists for their thoughtful opening remarks. Undersecretary Ted Mitchell, Rohit Chopra, and I will now pose questions for our individual panel members. And Jen, since you went last, we'll start with you. And I was just wondering if you could expand perhaps a little bit on some of the stories you were referring to from your survey, as well as other sources, and talk a little bit more about the experiences of interactions between student loan borrowers and their servicers.
Absolutely. So the participants in our survey filled out the survey online. They come from all over the country. They have an array of different levels of educational attainment. Some did not complete college. 46.3% have private student loans, 90% have federal student loans, 7% were not sure what kind of loan they had. And this is something that people say to us all the time. I don't know whether my loan is a federal loan or a private loan. And I think that part of the complexity about this federal-private split is that people don't realize that their servicer, which has a company name that's different from the Department of Education, is actually servicing their federal loan. I'd also like to highlight a lot of our borrowers specified the level of loan amount that they had, which speaks to how long some of these people will actually be in repayment. 23% have between $45,000 and $75,000 in student loan debt. And 16% had between $75,000 and $100,000 of student loan debt. These borrowers could be in repayment for 2 decades. So 7% of respondents said that they sent instructions to their student loan servicer and those instructions were followed. So the example that I gave earlier of the borrower who wanted their payment applied to the loan with the highest interest rate, 7% of the time, or 7% of the borrowers said that that happened. 15% said that, like I said, those instructions were not followed. And so I want to echo a lot of the sentiment that some of the folks around the table have said here in how we have to improve the borrower experience or the customer interaction experience that a lot of the 40 million people who have student loans are experiencing out there. 32% of the people who took our survey said that they had a servicer change and that they experienced problems. Now, this could have been in response to applying for public service loan forgiveness, but we feel that 32% of the people having problems is too high of a number. We really need to get that number down. I hope that that helps, and I hope that that answers your question.
It does. Thank you, Jen. Undersecretary Mitchell.
Sure, thanks. Tim, so what Jen described sounds a lot like widespread sort of stress, anxiety, difficulty in making effective communications back and forth. In that context, how has the industry responded? What kinds of changes in practices and procedures are you seeing?
What I first would put into context the scope of the problem. We hear the $30,000 in average debt for an individual with a bachelor's degree, but those individuals pay those loans back at about 97% rate. Or the borrowers with loans over $100,000, the vast majority of those borrowers are graduate students and they pay their loans back at a higher rate. So there's a large group of borrowers of the 1.2 trillion that are having a good experience. They're paying as agreed. And probably is because they were more prepared going into it. They graduated, as Dick said, and they were more prepared going into the process. I think the problem with a lot of the borrowers who are first-year dropouts that have $5,000 loan balance or less, and those are the predominantly borrowers that are defaulting, we're not getting information to them soon enough. We're not getting, you want to be able to speak to a student before he becomes a borrower, ideally. And oftentimes, servicers or collectors are dealing with borrowers way after the fact. They're in over their head. I have 2 kids in college, and I talk to their friends, and a lot of them sign what they need to sign to get into school, and they sign what they need to sign to stay in school. And then 4 or 5 years later, they see this big number, and it's very, very hard to help them with that big number if you provide information up front. So I think it gets back to communications on the front end, financial literacy services, how to choose a school, how to graduate on time, how to borrow responsibly, and so on. And then again, the communication piece. If you can't reach these individuals, as Dick said, a lot of times if they're in stress, they're not reaching out like they did in the survey for Young Invincibles. They're hard to find, and if you can't find them, it's difficult to counsel them. And if you can't contact them in the manner they want to be contacted, and I know if I don't send my kids a text, they don't communicate with me. I think that's fairly true for student or college students of all ages, and it's makes it more and more difficult to provide the counseling that they need. So I don't think it's a lack of servicers' will, certainly, or interest in helping borrowers. Nobody has an incentive in a failed situation for a borrower, but without early communication and consistent communication, it's just very difficult to make a difference. Thanks.
Deanne, you mentioned the need for transparent standards. I'm wondering, what do you think can be learned from standards and protections in other consumer financial markets?
Thanks. And a lot of the standard protections like credit cards and mortgages were enacted in response to crisis. And even though we don't draw all the same parallels, hopefully that we know that we can get out ahead a little bit, but we certainly have a pending crisis here too. What we're talking about, they're not, what's been enacted on mortgages in particular, there's still problems out there, we know that, but there has been a lot done in terms of, first of all, clear standards about things like basic customer service, about right to information about your loan or the loan product, and also even sort of the old RESPA qualified written request, which is now sort of a notice of error, where if there is a problem, there's a clear process about how you go through to find out. First of all, to let your servicer know that you know there's a problem, to make sure that there's a time frame and when they have to respond. Those sorts of things are all the kinds of things that are within the mortgage area. And I think very importantly, which is sort of what I was getting to about the comprehensive counseling, is required explanation prior to foreclosure, prior to accelerating the debt, of what the loss mitigation options are. And so that actually you can stop the clock for people before they go into these draconian default consequences and make sure that they are counseled properly. And we need more options on the private loan side, but at least some of the lenders do have them. But on the federal loan side, we know that there are a lot of those options. And then the last feature I would say, which is critical, and hopefully as we go through all of this, is that there's private enforcement associated with all of those rights as well. So that even though we know public regulation, that a lot of public regulators are stepping up more than they have in the past, this has been an area where there has not been a lot of aggressive enforcement. And so we're looking both for state, federal, public enforcement coupled with strong private enforcement.
Justin, both you and Chuck talked about the importance that the important role the institution plays in sort of a middleman in this, and that's partly about information and communication. But I'm wondering how you would see best practices in engaging servicers with you in making sure that some of this information is developed and promoted.
Yeah, thanks for that question. The thing that I think is most frustrating is there may be borrowers who withdraw from school, has been pointed out. They just go missing. It's hard to find them. They're not making payments. That's one set of challenges. And maybe we can, as you pointed out earlier, Dr. Mitchell, maybe there are things we can look at in auto-enrolling folks in income-driven repayment if the federal government or some agency at the federal level has their wage information already. But I think the frustrating thing is if there are process-related issues standing in the way of a willing borrower trying to make a payment or trying to get into a forbearance or deferment and can't because it's so complicated. In those instances, they may very well come back to the school to act as an intermediary on their behalf. The number one challenge that schools cite is this inability to easily look up and see what the different processes are between servicers. So in the old, Chuck talked about the Federal Family Education Loan Program. In that program, which was bank-based lending insured by the federal government, they had a manual that outlined all the standard practices between all the lenders and guarantors in the FFEL program. Where there were differences, there was an appendix that said this agency, this guarantor will handle this process this way, this guarantor will handle this process that way. Nothing like this exists, and we understand there will be differences in servicing because this is a competitive market. We're trying to leverage the best out of every servicer, but a school's inability to understand what those differences are in a very easy way leads to a lot of unnecessary work and roadblocks in the process. The second thing I would say that we hear a lot of is concern about marketing and the firewall between servicers who have other lines of business and their federal servicing contracts. So for example, last week we saw an example of a school who sent us a piece of marketing that a servicer was doing on a private consolidation loan that would consolidate federal and private loans together. That same entity is also a federal loan servicer. We don't understand, or it's not very transparent to us, what those firewalls are between their role as a federal servicer and then another line of business where they're doing private student loans or other collections or servicing.
Dick, the Bureau's analysis of student loan defaults suggests a balance that is much lower for defaulters on average than the typical borrower, which is what you mentioned about non-completers. What other data do you have that suggests a warning sign for borrowers, and how do you use that in your business?
Well, there are sort of two levels of warning signs that one could think about. We could use predictive analysis based on some fairly limited demographic characteristics, zip code of residence, college attended, things like that. With 4 or 5 pieces of data, we could probably get to a 95% confidence level on the probability of ultimate delinquency and default. Now, there are some statutory limitations on what sorts of demographic data we're allowed to use, but I think you could build a very robust predictive analysis and then provide some targeted counseling to those borrowers well before they enter school. So something I think could be developed in that space. Once they're in school and once they've borrowed, the warning signs are pretty obvious. Clearly, the most important warning signal is early withdrawal from school. As I said, that's the cohort that is comprised of the most vulnerable students, and that is the single most important warning signal. And one of the things that we could do, and it's a possibility that we could work with institutions to do, is get earlier notification of withdrawal. Currently, it can take quite some time, one, before the school recognizes the student is withdrawn, and two, before the servicer then receives the notification. So if we could accelerate that process, we could potentially be able to reach that student before they've moved or relocated and become a skip. The other thing that we see in a warning signal is did they actually receive exit counseling or not? We've done some data sampling on that, and it's pretty clear that it has an impact. Some 23% of borrowers who receive exit counseling will ultimately become delinquent or default, whereas 37% of those who don't receive exit counseling will ultimately become delinquent or default. So that's another warning signal. And the other ones that are equally important are we able to be in contact? Does that borrower log into our site? Have we actually had a right party contact with that borrower? Has that borrower ever been able to sign up for auto pay? Has that borrower changed repayment plans while in grace? All of those things signal a propensity to delinquency and default going forward. And we could develop more targeted programs to work with those borrowers where we see those warning signals. But the ultimate problem, as Tim alluded to, is TCPA and other constraints on our ability to contact borrowers, and the fact that when borrowers drop out, they've had a failure experience, and oftentimes they're psychologically predisposed not to want to talk to us. So even if we have a number, even if we have a good address, in many, many instances, it's going to take a different type of counseling to reach, communicate effectively with those borrowers, even when we know the warning signals.
So Chuck, Deanne really has talked a couple times about the sort of the heart of the matter being how servicers provide counseling and guidance to borrowers. You hear from the other end. You hear from alumni and graduates, other graduates of other places, other institutions. What perspective are you getting from them on the quality of that advice?
Okay. Justin mentioned earlier a survey that the Direct Loan Coalition and NASFA worked on together, and we asked that specific question. I think Justin even cited the statistic that half of the financial aid administrators who responded mentioned that, in their opinion, when they've talked with students, repayment plans were not clearly explained to them. And it actually went up to about 60% specific to income-driven plans. And that's a very telling statistic, of course, but it's just a yes or no box. I think the comments are where we really start to dig into the problem. And as I look through the various responses, a couple of themes came out. A few responses noted that when borrowers asked about income-based repayment, they were told they needed to enter one of the standard repayment plans first, and once they got into the standard, they could talk about moving into income-based repayment. That's obviously a concern if that's happening. Others mention that, and we've heard this very consistently for years, that when a student contacts a servicer who is having problems, when the student is having problems making their payments, the immediate reaction is deferment forbearance. And of course, this has been somewhat rectified with the new pricing structure, but that's a faster process, and thus, as was mentioned in the opening remarks, tends to be a cheaper process for a servicer to go through than actually going through the steps to put a student in income-based repayment. Now, we're very happy that the steps to income-based repayment are getting easier to get in and stay in, and we're happy that the incentives have changed. So there's definite progress on this just since 6 months ago when we did the survey, but it's still important to note. We also heard with some relative frequency that information coming from the servicers, from different servicers, was inconsistent with each other, and that was mentioned earlier. Justin mentioned but also even depending on which customer service rep you got on the phone, you might get different information even at the same servicer. And then the last comment, which makes some sense, but I want to note, is that the schools noted that when the school got on the phone with the student, the advice and the experience went a whole lot better than when it was just the student. And that, of course, makes sense, but the fact that that's coming up and schools are noticing that, I think, is of concern. Now, I say all that, but now I want to come to the defense of the structure we have, or to the servicers, really, based on the structure we have in place. You mentioned that just last week they wrapped up negotiated rulemaking on another repayment plan. That seems to be going in the wrong direction in a whole lot of schools' opinions. There are currently 6 that introduces a 7th. And to be honest, if I was on the phone at one of the loan servicers and tried to explain 6 or 7 different repayment plans to a student, I can't imagine that conversation going well. There's just simply too many options. So I do want to take this time to call upon maybe calmer minds to say, let's settle on a couple of plans and move forward, and I think this will solve some of the problems as well. And I want to mention one other idea. Dick mentioned exit counseling, and the Direct Loan Coalition has come out with a proposal. Currently, exit counseling occurs at the school level. When a student graduates, and this doesn't get at the ones who withdraw, but when a student graduates, we know they're graduating, we send them information about, here's something you need to go through. It talks about your repayment obligations, different repayment plans, that sort of thing. But note, it's for students who graduate. We can't proactively send it out to those who withdraw, and very accurately that was noted that that's one of the bigger problems. Potentially that might be moved onto the servicing end. So even if we have a student, so we send out exit information to our students in March or April for those that graduated last week, and they fill that out, yet they won't go into repayment and select a repayment plan for 6 months after graduation, which is close to Christmas. So maybe the exit counseling process could be moved, and there's your consistency now. So now you have a consistent process right before a student goes into repayment where all the different repayment options are outlined, and then perhaps the servicers could help with that process. And maybe that might provide some of that upfront information that the students need.
Great. Thank you, Chuck. So we have reached our lightning round. I will have one question that I will ask each of the panelists to respond to, and Chuck, you certainly touched upon this yourself in your remarks there. and just ask you all if you could give one or two best practices or areas of improvement that you would like to see in the student loan servicing market. Jen, we can start with you and just work our way around the table.
Absolutely. One area of improvement that we would really like to see after hearing from borrowers is to release information about how servicers are doing. I think, you know, we have advocated for some time for a complaint system, which we're thrilled that some people are taking interest in. But, you know, a lot of borrowers out there feel like the struggles that they're going through in dealing with their servicer or paying down their debt, they feel often very alone in that. And I think that there are many borrowers who look for answers online and can't find them, sometimes contact their servicer and don't get a good resolution. You know, we try to direct them to CFPB whenever we can to file complaints, but you know, I think that there has to be better consumer information out there about performance. Another thing that I think would be a big help is to, you know, definitely hold all the servicers to an absolute standard. And this is something that I think many have advocated for in the consumer space, but I think that, you know, competition between the servicers is a good thing, but if you're holding servicers to a standard that is only set in place by the absolute best performer, but, you know, isn't across the board, I think that there's just better incentives out there for these companies.
So, excuse me, so two things quickly, and this was allowing people to switch is really important and certainly probably the best way to figure out what customer service or shopping. And then having specialized either within the same servicer or potentially experimenting with other ways so that there are specialty units. I think it's the best way to get at giving people accurate advice about the range of options. It's not, in my view, about contact. That might be an issue in some ways, although that's a separate issue. I'm on the line all the time, or quite often with my own clients. I hear inaccurate information being given to them all the time. We now have a crisis really in the for-profit school industry, which we all know about, and these servicers should be ready for that, but if they're not ready yet, at least get some specialized unit within your servicer so that really vulnerable people can get accurate information.
I'll give two real quick. A couple years ago, I moved to take the job at Clemson. I was in Ohio, so I moved to South Carolina, and I had a question about my taxes, and I contacted the address and the phone number that I had when I was in Ohio, and they told me, well, you live in South Carolina, you have a different servicer. So I had to contact the IRS servicer for the southern region, and it hit me that there are multiple servicers servicing tax forms, and I didn't know that. And maybe that's a model where we can still have the private the private industry involved with servicing, but keep that information. Don't make it so public to the student. And I mentioned earlier how important that is. The second, and Deanne alluded to this a little, and I'll follow up. In the mortgage industry, when loans are sold between entities, there is a law, and I believe it's in the Truth Lending Act, but I'm not sure where the law is, but it states that the bank draft information, when a loan is sold, must transfer with the loan, and the borrower cannot see an interruption in the bank drafts of their mortgage payment. It seems like simply, I'm a computer guy, it sounds like copy and paste that right into the student's loan servicing, and we would address a whole lot of the concerns with the 10 million borrowers who switched servicers.
Just to repeat one of Deanne's on specialty counseling, clearly a best practice, and we're already well along where we've established SCRA counselors and IDR counselors so that as calls are escalated, they can go to much higher level and more experienced counselors who focus specifically on on one or more of those benefit programs. And clearly, that does have a positive impact on borrower understanding and outcome. But two things I would offer as best practices. One would be much more robust financial literacy training. I would almost make Title IV eligibility conditional on having 4 credit financial literacy courses at the institution. You know, if we have expert counselors in our call centers and the level of financial literacy among the borrowing population remains where it is today, the ability for that communication to have a positive and meaningful outcome is pretty limited. And I think, you know, institutions in the Department of Education could work towards that goal of mandatory credit-bearing financial literacy. The other thing that I would suggest as a best practice is limiting the duration of forbearance. Too often times, you know, we see forbearance used as if it were a repayment methodology as opposed to a step to get to an effective repayment methodology. And I think we can do some work to limit the duration of forbearances to what would be needed in the individual borrower's circumstance. So if they say, I can't make my payment this month, I'm getting a new job, I'll be able to be back on track in 60 days or 90 days, the forbearance should be limited to that 60 or 90-day period. Otherwise, the potential of losing track with that borrower is significantly heightened, and that ultimately is what leads to breakdown of communication, delinquency, and default.
Well, Dick put it very well about financial literacy, the need for that, and so I would just add a bit of caution to what the counseling is, because we've kind of gone from an idea of you borrow, the advice you give to a young person or anyone going to school is you borrow only what you need and pay it back as quickly as you can. And we've kind of morphed to this, don't worry so much about how much you borrow, and if you pay it back long enough, some of it will be forgiven. And Senator Harkin made a good comment at a hearing last fall that, you know, be careful about the advice. If we talk to borrowers, don't discard the standard repayment, which might get them to pay the loan off in 10 years. It might be $40 a month more, but they'll pay it off in 10 years. That little bit can make a difference. And if they pay it in 16 years, they don't get the forgiveness if they're in a 20-year forgiveness program, and they've paid interest for 6 years more than they needed to. So, you know, we try to simplify these programs, and IBR is good for a lot of people, but IBR isn't for everybody, and we need to be careful that that's not just a one-size-fits-all.
The best practice that I would highlight, and I apologize for sounding like a broken record here, but I'll just say it again, which is transparency is a good thing. Common policy and procedures manual. Drive servicers to the best practices because they're transparent to everybody on what they're doing with every practice that they're engaging in with borrowers. And 2, it helps schools know how to help students when they act in that intermediary role.
Great. So thank you, everyone. At this moment, I'll ask our panelists to rejoin the audience. Please, everyone, join me in thanking them for their participation in our field hearing today. At this time, I'll turn it back over to Zixta Martinez, our Associate Director for External Affairs.
Thank you, Steve. An important part of how the Bureau helps consumer finance markets work across the U.S. is to hear directly from consumers, from industry, from our state and local partners, and from community advocates. One of the ways that the Bureau gathers public feedback is through public events such as these. We've held public hearings, public town halls, and other events in places like Minneapolis, Indianapolis, Birmingham, Alabama, Sioux Falls, South Dakota, Durham, North Carolina, Detroit, St. Louis, Atlanta, Des Moines, Iowa, Miami, Los Angeles, Itta-Bena, Mississippi, Oklahoma City, New Orleans, Phoenix, Nashville, Reno, Nevada, El Paso, Texas, Newark, New Jersey, Richmond, Virginia, and of course, now we can add Milwaukee, Wisconsin. At these events, we not only hear from experts in the field, we also invite the public to participate And before I open the floor for public comments, I wanted to remind folks that there are several other ways to communicate your observations, your concerns or complaints to the CFPB. You can file a complaint with the CFPB through our website at consumerfinance.gov. Our website will walk you through the process for filing a consumer complaint about a financial product or service. The CFPB takes complaints about mortgages, car loans or leases, payday loans, student loans, or other consumer loans. We take complaints about credit cards, prepaid cards, credit reporting, debt collection, money transfers, bank accounts and services, and other financial services. If you don't have a specific consumer complaint but would like to share your story with us, we have a feature called Tell Us Your Story, where you can tell us your story, good or bad, about your experience with consumer financial products or services. Your story will help inform the work that we do to protect consumers and create a fair marketplace. We also have another feature called Ask CFPB, where you can find answers to over 1,000 frequently asked questions about consumer financial issues, as well as additional resources. I encourage you to visit consumerfinance.gov to learn more about the resources and tools the Bureau has developed to help consumers make the best decisions for themselves and for their family. Now it's time to hear from public participants here today. A number of you have signed up to share public comments and observations about today's discussion. The public comment portion of the field hearing is also an important opportunity for the CFPB to hear about what's happening in consumer finance markets in your community. Each person who signed up to provide testimony will have 2 minutes to do so, and what we hear from you is invaluable. We want to hear from as many of you as possible, so I encourage you to please observe the time limit so that everyone who signed up to share their observations has the opportunity to do so. Our first member is David Mansell, who is with the Wisconsin Department of Financial Institutions. David?
Good morning. Good morning, and thank you for the opportunity to come to Wisconsin for this important topic. I was encouraged to hear about the possibility of requiring some financial literacy for such loans or grants in the future. So I'd be encouraged to keep that comment going and that discussion going.
Thank you, Mr. Mansell. Thank you for joining us this morning. Karen Bauer.
Hi, I'm an attorney at the Legal Aid Society of Milwaukee, and I very frequently deal with borrowers in distress. But the first thing I wanted to talk about today was my own experience this week. I owe $127,000 in student loans, and like I said, I'm a legal aid attorney. So as you can imagine, I have a partial financial hardship, which means that I'm doing income-based repayment. When I did my taxes, I realized that I'd had a substantial change in my income in the downward direction, unfortunately, and I called my servicer. I know what the rules are, but I wanted to check in and see what they said. And I said, my income went down. I need to talk about my income-based repayment. Their response was, you're not up for recertification until September. You have to wait until then. And I said, no, I don't think I do. And their response was, if you send that in now, we will deny it. And I asked for a supervisor. We resolved it, but if my student loan servicer is giving me false information, that's true for almost everyone. And I think among my clients, I've had issues like people who call and say that they're disabled and they're never told about the possibility of a disability discharge on their student loans. That's a big one. I've had people who've had lawsuits filed by private student lenders with inadequate documentation attached to those lawsuits, very similar to the robo-signing crisis with mortgage foreclosures. Predatory actors soliciting borrowers via radio, TV, letters, the internet to pay for student loan consolidations through direct loans or to set them up with income-based repayment. I really think that some regulation is called for in that arena because no one should have to pay to sign up for income-based repayment. Also, I have borrowers who attend school for a day, a week, or a month and then withdraw and owe thousands of dollars. And the problem there is that the school is not telling people at the time that they're withdrawing from classes, you will still owe money. So I think that's a big concern too. But the item that I wanted to speak to you about very quickly was the possibility of setting up a hotline similar to the Homeowners Hope Hotline, which is independent of the servicers so that people can call someone who's not their servicer if they think something's up, if they're told they can't recertify their IBR for 5 more months, so that they can get some unbiased information regarding their loans and the repayment possibilities. Thank you.
Thank you, Ms. Bauer. Selma Ali. Bill Drewliner. John Fisher. Oh, there we go.
So thank you. I appreciate the CFPB's focus on this really important issue. It's clear that the mounting level of student loan debt and confusion regarding options is an issue. I am Bill Drewliner. I'm the Community Engagement Manager for Green Path Financial Wellness. We're a nonprofit national financial education and counseling organization. And we have 60 counseling locations in over 16 states and served 200,000 households last year. We did an internal review of clients that were calling us saying that they had issues with student loan debt, and we found last year that they had a very similar profile to consumers that called us with credit card debt issues or mortgage delinquency issues as well. So what we've really found is that there really is a separate issue between good advice being given from servicers and the need for holistic financial counseling for consumers. Even the best servicer with the best process and the best intentions at heart will not be able to help a consumer that also has a mortgage delinquency issue or is carrying credit card debt at 28% interest. And so it's very important that there's the opportunity for holistic, nonprofit, accredited financial counseling to be available for consumers. Currently, the state of play is that it's really difficult to tell legitimate players in the financial counseling industry from those that are scammers. There's a lot of advertising happening in this space. And a challenge that we have is that currently there really is no funding mechanism for nonprofit agencies to be able to offer counseling in this way. So even those nonprofit agencies seeking to help consumers really only can resort to a client pay model to be able to do it. That causes confusion between the legit and the illegitimate players. There has been a proven model showing the effectiveness of holistic financial counseling, both in the pre-purchase counseling space, in decreasing subsequent mortgage delinquencies, as well as in the foreclosure mitigation space in helping to drive better outcomes for consumers that are struggling. And so we really would encourage you to look at nonprofit agencies that have had experience in both financial counseling and credit counseling, as well as the housing counseling space, because there actually is capacity in that industry right now to be able to help with this issue due to the decline in foreclosure issues across the country.
Thank you, Mr. Drewliner.
No problem.
John Fisher.
Thank you. I didn't really know I was going to be called on, but I'm with Money Management International. And we're the largest nonprofit national counseling organization. We're a member of the Hope Now hotline organization, and I think that's an excellent model to consider here. There's so much that we can do here in terms of providing not only complete holistic counseling, but there's a lot of things that we can do that might be beyond your imagination right now. There's things that we can do, like we can record every phone call that we have. We can use tools to mine that information, protecting the information of the person, to understand why are they calling, what are the things that they're asking us. We can provide excellent reporting and all those things. So what's interesting, as Bill talked about with regard to the credit card challenges and the housing challenges that we're seeing right now, is the engagement piece. And it was mentioned by a lot of the panelists that the challenge is sometimes to get the people on the phone and talk to them. And that's the outreach part, but the other part is the in-reach part. And what we've seen historically is people don't call. They don't always know what's going to happen when they call, and they fear acceleration of their problem. by the party on the other end. They sometimes generally will trust a nonprofit organization more, not always. I think they trust the people on the Hope Now line more because it's supported by a lot of people. In many cases in these markets, the only thing that comes out in the press are the problems and the people to avoid. And what happens is everyone avoids everyone. And then, sometime late at night, they see the late night ads, and it's very current in the student loan market right now. We'll fix your problems in 15 minutes. Well, nobody's going to fix these problems in 15 minutes. It takes a very engaged, knowledgeable, trained person to help them with that. So I think that's a really important thing to consider. We're not the whole solution, but the counseling organizations that Bill and I represent, two of the largest, could do a lot. You could do a very interesting trial here, so thanks.
Thank you, Mr. Fisher. Jessica Roulette. John Wasik.
Hello, I'm John Wasik. I've been writing about this for Forbes, and I'm also researching it for the Nation Institute. Some of these predatory practices are way out of control. There's firms across the country that are exploiting a lot of people, and they're completely unregulated. My question for Undersecretary Mitchell is the Department of Education going to begin to regulate these firms? Do you know the scope of the problem, and how would you approach it?
This is not Q&A with the press at the moment. I'm sure Undersecretary Mitchell would be glad to speak with you following the field hearing, although I certainly can't speak for him. But thank you for your participation here. Saul Newton.
Thank you. First, I want to welcome you to Milwaukee and thank you for taking this, for holding this hearing and showing an interest in this important issue. My name is Saul Newton. I'm a college student. I'm also a veteran, and I'm a student loan borrower, and I'd just like to tell you my story. I started my college career actually 8 years ago now. I was the first in my family to go to college, and it was very important to me that I get my education. And so when I graduated from high school, I started attending a small state university here. Certainly not an extravagant school or one that by comparison would be very expensive. I was trying to be responsible. But my family couldn't even afford tuition at a state university. And so in order to afford my tuition, I had to rely on financial aid, and particularly student loans. And while I was in school, I worked several jobs to make ends meet, but I was drowning. In the 2 years that I was enrolled at this particular institution, I saw my tuition go up $1,600 a semester. And so after 2 years of attending school, I couldn't afford it anymore, and I had to drop out. And I ended up joining the military so that I could have access to the GI Bill in order to serve my country and come back and continue with my education. And about 3 months after I dropped out of school, I was deployed to Kandahar in Afghanistan. And while I was deployed to Kandahar, I was going on daily patrols. It was a very active area, and it was a time in Afghanistan where it was not good for us. But while I was going out on daily patrols, I was also forced to continue making my student loan payments. Because if I didn't, it would be disastrous for my personal credit and my financial future. And so for 12 months, while I was deployed, I was making my student loan payments. And now I'm back in school, and I'm really thankful that I have the GI Bill at my disposal, and I'm able to continue working on my education. But students shouldn't have to go to war to afford a college education, and while they're serving in war, and while they're deployed, their focus should not be on making their student loan payments. The other thing that I would just like to add, separate from that, is there, one of the panelists briefly brought up something that I've seen up close, not personally, but through friends of mine, and that's predatory institutions, particularly preying on veterans. And for-profit schools who are who are preying on veterans are a big driver of this crisis, and there desperately needs to be something done about that. So, thank you.
Thank you for your comments, and thank you for your service to our country. Tom Penalung. Becky Thies.
Thank you so much for holding this hearing today on such an important topic. As we've heard, over 40 million Americans have student debt, and as many deal with this debt, they rely on loan servicers for information about their loans, to obtain a deferment or forbearance, or to enroll in an alternative repayment program. Unfortunately, as we have seen in the mortgage market as well, far too many borrowers have unsatisfactory experiences with their servicers, ranging from unfair treatment to being subject to illegal practices by servicers as they pay back their loans. The CFPB itself has found that student loan servicers were harming borrowers by doing things like allocating payments so as to maximize late fees, deceiving borrowers by misrepresenting minimum payments, charging illegal late fees, not being upfront with consumers about protections they have under bankruptcy laws, making illegal debt collection calls, and failing to provide accurate tax information. The CFPB should use the authority that you do have to make sure borrowers are treated fairly and that they get the information that they need to take advantage of any repayment plans available to them. This means that abusive, profit-increasing practices that are banned in other consumer debt industries but are still used by companies that collect payments on private student loans must be curbed. Incompetent servicing practices truly harm borrowers. Too many people are getting squeezed by practices like servicers misapplying payments. To help borrowers to the fullest extent possible, the CFPB should act now with the authority that it does have to help borrowers, but also needs to be creative moving forward to figure out which interventions will best help in this industry. Thank you.
Thank you, Ms. Thies. Emily Brunges.
First of all, thank you for the opportunity to share comments today. My name is Emily Brunges. I'm here with colleagues from the Wisconsin Hope Lab, where I work as data manager and analyst. We are a translational research lab, primarily concerned with college affordability, and very concerned with the issues being discussed here today. They're central to what we do because we're interested not only in students getting into school, but also completing their degrees. I hope you'll forgive me. I really appreciate the tone and the direction of this conversation, but being an organization that's really focused on affordability, I'd like to shift the focus back there again because we know that the cause of student debt is that college is really not affordable for so many students. Here in Milwaukee, as an example, University of Milwaukee has seen a huge swell in enrollments. At the same time, state appropriations have remained relatively flat. And so the result, of course, is that the cost to students has gone up dramatically. This puts students in a pinch. For a lot of these students, from low to moderate income families, they may face a bill of upward of $15,000 a year in order to attend college, even after you account for all of the grants that they've received. And not surprisingly, they turn to loans to cover that difference because, as others have mentioned, work is really not going to meet that balance. And so now we see over 75% of graduates from UW-Milwaukee graduating with somewhere averaging around $33,000 in debt a year. I'm sorry, not a year, but in total. And entering a weak economy, entering a job market in a city that is profoundly segregated, they find themselves in a very difficult situation, and their odds of repayment are too low. So my contribution to this conversation is to say that while it is good to improve terms of repayment and to address issues with servicing, really we need to go deeper than that and go to the core of the issue, which is about college affordability. And so we're very excited about the partnerships that are happening between the Department of Education and the CFPB, and would like to see that continue in the search for how to make college affordable.
Thank you for your contributions and for your tone. We appreciate it greatly. Dan Riel.
Hello. I've been a student at college a number of years ago. I have graduated with a 3.84 on my GPA, highest honors. And I have found after I had graduated that my degree is essentially garbage. On top of that, you know, being unable to get a job in the career for which I have studied, I have also met with my servicer who has not been entirely forthright with me on a number of issues, starting with, you know, the income-based repayment. I was put on such a program, but after 3 years, I've noticed that I now owe, you know, $10,000 more than when I graduated, despite the fact that I was even trying to make more than the minimum payments. Okay, what that says to me is that there is no point in trying. If my best will only get me deeper into debt. Fact of the matter is, I'm not even the worst case I know of who I've gone to school with. I have a friend who's been told that they now have to pay $1,900 a month when they only make $12. You know, this is unconscionable. Furthermore, there's, I'm sorry, there's also the fact that these servicers aren't being truthful to us. You know, they tell us, oh yes, we will get you paperwork to, you know, put you onto, you know, this program or that program, forbearance, you know, deferment, income-based repayment. They'll send the paperwork sometimes. And even when you send it back to them, they've been like, we never got it. I have been forced into default by my servicer because they have been unwilling to work with me and I can no longer trust them. And yet, you know, I've heard some discussion about how an exit counseling should be taken on by the servicer. Why, if I cannot trust them? Thank you.
Thank you. I hear the frustration, and I can only begin to guess at how difficult it must have been to gather the courage to share that with us. We're deeply appreciative that you did. It is inspiring to us to make sure that we keep our nose to the grindstone and continue to do our part, modest though it may be, to make things better in consumer finance markets because it's really about consumers. So we're deeply grateful that you are here. Katie Buitrago.
Thank you. Thank you again for shedding a light on this important issue. And I'm here from Woodstock Institute. We're a research and policy nonprofit in Chicago. And I'm here to talk a little bit about some research we just released on for-profit colleges, which has been alluded to by some of the other people who've testified today. And I think a lot of these schools, you know, produce poor outcomes that lead to issues with repayment and ultimately servicing problems. As you know, for-profit colleges are educating a growing proportion of undergraduates, especially low-income students and students of color, and are often more expensive than comparable programs at public colleges and produce worse educational outcomes. Just 1/4 of African-American students at for-profit colleges graduate within 6 years, and many of them are under investigation. Our research found that many students at for-profit colleges are more likely to borrow and borrow more than students at other types of schools, even controlling for important factors that influence debt, like socioeconomic background, college costs, financial aid and resources, and more. Our report found that students at 2-year for-profit colleges were nearly 50% more likely to borrow than students at public colleges. And you look at it by race, Latino students were more than 3 times as likely to borrow at 2-year for-profit colleges, and African-American students were more than twice as likely to borrow. Latino and white students at 4-year for-profit colleges were significantly more likely to borrow than similar students at other schools. And students who borrowed at for-profit colleges took out $1,300 more on average at 2-year schools than at other types of schools. Based on these findings, we're concerned that there's something happening in the business models of for-profit colleges that encourages students to borrow to finance their educations rather than seeking out other options. This merits further investigation. Colleges that foster unaffordable debt and generate poor educational outcomes should not be allowed to take advantage of students. We applaud the CFPB's announcement today that it's launching an inquiry into servicing practices that harm so many for-profit college students. We urge the CFPB to create servicing standards that encourage affordable repayment options, improve communications between servicers and borrowers, use an appeal process for dissatisfied borrowers, require timely and application of loan payments, and early notification of resources for borrowers in default. Honor payment plans while servicing rights are transferred, and provide adequate and well-trained staff. These changes would help ensure that borrowers who cannot afford their loans, especially students who attended for-profit colleges, are treated fairly and have the opportunity to pay what they can until they get back on their feet. Thank you.
Thank you, Ms. Betrego. Martha Martin.
Hello. I'm here as the parent plus loan giver, whatever term we'd use there. My experience was with direct loans and Great Lakes loans. My son and I had taken out loans over the course of his 4-year undergraduate experience at a state school. And things seemed to be going fine. I was paying more than just the interest each month, between $230 and $450 per month. And then one month, in February of 2013, instead of $230, $2,300 was automatically deducted from my account. I called the following Monday to Direct Loans, and they said, sure, no problem. We'll send you a check in the mail. A few weeks later, I still hadn't gotten the check, and I noticed that Direct Loans had been sold to Great Lakes, at which time I called Great Lakes, and they said, oh, well, that's on them. There's nothing we could do about that. We're not sending a check to you. I called Direct Loans back. No, that's now Great Lakes. We don't own it anymore. I worked my way up the chain. I was told, well, of course, you must have okayed that. Otherwise, there's no way it could have happened. And I said, it was just a decimal problem, obviously. But just so happens I need to get a new roof this month and a new washing machine and a new front porch. And my son is getting married, so I really can't afford this extra amount, and I'm a retiree. Over the past 2 years, I've been hung up on numerous times. I finally did get a 3-way conversation between Direct Loans and Great Lakes, and it sounded like Great Lakes would do something, but then they called and said no. I went to the ombudsman at Great Lakes. I was just kind of laughed out of the situation. I found out I could call the Department of Education and spoke with their ombudsman. And I went through 2 different people. They lost my file. They said, well, why did you send in a check for $2,300? I said, no, it was automatic deduction. They said, oh, well, Great Lakes says and Direct Loans say they have no record of you ever calling them. Might I add that it went past the 2-month period in which I could have asked my bank to, collect on that for me. So I was just out of luck. Additionally, I'll just quickly say that I was given paperwork with pages missing that did not. I showed an accountant for the airport who's a friend of mine. Do you understand what this is? No, he did not. I couldn't see how, after taking out $28,000 of loans and paying for 6 years, I then owed $24,000. That didn't make sense to me either. But nobody ever could address that. They didn't, not to be rude, but nobody seemed to have the mathematical know-how to answer any of those questions with whom I ever spoke with. So anyway, I'm here. I know I'm not alone in this. Luckily, my son graduated and his grad school and all that good stuff, got, scholarships. But I just think this is really ridiculous, and I hate to think of students whose parents are not native English speakers. I don't know how they would possibly navigate any of this, so thank you very much.
Thank you, Ms. Martin, and thank you for taking time to share with us today.
Did you ever get the $2,300 addressed?
No, I was finally told by the federal student loan department ombudsman that if I wanted to apply, I could, but then I'd have to pay the 7.7% interest. So basically, it'd be a loan on a loan. And in the interim, what I ended up doing is getting a home equity loan and just paying off the $24,000 because, It just
Just
got
one,
to be.
one more chance on this. Will you file a complaint with the CFPB and somebody will come around and talk to you about how?
I'd
how you
love
can
to,
do that?
yes,
Okay,
thank you.
all right, we'll just see if that helps.
Okay, thank you.
Desiree Cockruff.
Hi, I'm Desiree Cocroft, and I actually am a program manager for a nonprofit in Milwaukee called Make a Difference Wisconsin. And so we do financial literacy for high school students, and just given the conversation that I have with a lot of kids that are going to college and the things that they don't understand, up to the financial aid award, like what is this and what does it mean when I circle this, shows me that financial literacy is definitely a key indicator. And even with my own story, so when I finished college at private institutions, I came out with $83,000 in debt, and having graduated with that amount of debt, I think that I could have used what I'm giving to students at that time because I wasn't paying it off. I did forbearance because I just didn't think you could really pay off $83,000. Like, does that really happen? And so, you know, I spent a lot of time not paying more than the minimum and not thinking about how it can actually be paid off. And it wasn't until I started to do more financial literacy education for myself that I realized, you know, it is possible to pay it off. And so I think someone on the panel even mentioned the thinking about taking out what you need and paying it off faster. That wasn't a frame of mind that I had. It was like, what can I do so that I can have my tuition paid off, and then I'll figure it out at some point. And I think that that is the case with a lot of students, especially like myself, not having a family that could tell me, hey, this is what you do, so that you can be debt-free afterward. It was like, hey, you need your tuition paid. And I was the first in my family to go to college as well. So in their mind, they're like, hey, if you're getting offered that, then take it so you can go to school. But no one being able to support me afterward, and having a family that had consumed debt and debt issues. In my mind, it was a part of life to have those kind of issues, and you figured it out at some point. And so giving the fact that I ended up doing my own financial literacy for myself, I started getting very serious about paying off my student loans, and now I only owe 23 after 83, and I've been paying it off for 7 years. I'll be done at the end of this year, and it wasn't because I make 6 figures or anything like that, but it was paying more than the minimum and actually having a service provider that worked really well with me, and that's not the case with a lot of people, so I've heard, but having, I guess, the optimal partnership. I wanted to pay it off sooner, and I had a service provider that made it easy for me to do it, and I've been able to do that, and it was only after being financially literate, and I think that that is very important, having worked with seniors in high school that don't understand what it really means to take out a loan and doesn't even really understand what it means to pay it off later. I think that it's really a psychological thing when it comes to how do you pay it off, how do you budget to make that happen. So I would like to see a lot more financial literacy on the front end, because it sounds like there's a lot of back end conversations today.
Thank you, Ms. Cockruff. Scott Ross.
Thank you, Director Cordray and your team, for bringing the Consumer Financial Protection Bureau to Milwaukee. My name is Scott Ross. I'm the head of One Wisconsin Now and One Wisconsin Institute. We're nonprofits out of Madison. Certainly your work and the stories of borrowers here today are exposing a crisis of affordability in our higher education system. The 43 million student loan borrowers nationally, including 1 million here in the state of Wisconsin, have done the right thing. They're working hard to get their education or job training, and they've taken the personal responsibility for paying for it. They've earned the right, the same right, to a shot at the middle class that previous generations got. They have the right to expect that as they make good on their loan payments, they're going to be treated respectfully and fairly. And I think my story is one example, and I do consider myself one of the lucky ones. At the advice of my loan providers, I consolidated my student loans back in 1999 at an interest rate of 7.875%. I paid those loans off until 2013 after nearly 20 years, but because I could not refinance, I wasted $21,000 if I could have got my interest rate down to say 5%. No, I would have spent $21,000 more in the economy. And I think research that we've done at One Wisconsin Institute shows that how student loan debt has impacted our state economy. As state support for higher education has declined here in Wisconsin, for instance, $70 million in cuts to the technical college system, the oldest in the United States of America, $650 million in proposed or actual cuts to the University of Wisconsin system, millions of dollars more in tuition paid, and 41,000 eligible financial aid borrower, 41,000 who were eligible for financial aid denied financial aid last year, it's obvious that, that the burden of higher education is being shifted to students and their parents as opposed to the investment we used to make as a society in higher education. Today, according to figures, we know that over 800,000 in the state of Wisconsin owe nearly $19 billion in federal student loan debt. Student loans are taking an average of nearly 20 years for the average borrower to retire, and monthly payments translate into lost lifetime wealth and reduced economic activity. Not only borrowers, but our entire state economy feels the weight of the student loan debt burden. My hope is that someday in this country we will have debt-free higher education. But I also hope today we can take some real steps to help student loan borrowers, making sure they're treated fairly by loan providers, making sure they have the same consumer protections of every other consumer transaction in the United States, and that they can simply refinance their student loans like you can a mortgage. Again, I want to thank you for coming. Really appreciate you putting attention on this and coming to Wisconsin on a nice day like this. So thank you.
Thank you, Mr. Ross. Lawrence Hoffman.
Thank you. I was a teacher, and I went for my PhD at age 44, and after 6 years, I got the PhD and ended up with $38,000 in student loans. It seemed like it was something that I could handle, but Sallie Mae represented itself as being a government agency, so I trusted them, and I took out a 9% loan on the consolidated loans. Long story short, I eventually left teaching and ended up at one point paying $750 a month with hardly any income. Fortunately, someone in a government ombudsman helped me with information, and eventually, not through Sallie Mae, Great Lakes helped me to realize that now there's income-based payment. And so my income-based payment now is $150 a month, which is affordable, definitely. However, I have now paid $51,000, having started with $38,000, and if I paid it off today, I would have to pay $137,000 more. I will never be able to pay this loan off, never. And I don't want Sallie Mae to get the rest of it when I die, because I'm sure they have insurance that covers that. So I hope maybe direct student loans will help, or in some way I can keep Sallie Mae from getting some $150,000 or $200,000 when I'm gone.
Thank you, Mr. Hoffman. Robbie Hilton-Smith.
Hey there, folks. Thanks for the opportunity to testify today. I'm Robbie Hilton-Smith. I'm a policy analyst at DEMOS, which is a national public policy organization. And I, as previous commenters have, want to refocus the discussion a little bit on the causes of student debt here. It's all good to look at different ways to help repayment. That is certainly an important focus, but we have to recognize that the reasons why people are borrowing so much is, as previous people have said, college has become increasingly unaffordable, especially in the past decade, and the impact of that student debt on people's financial futures. So we have done a couple of pieces of research on this. In the most recent one that we came out with, we looked at costs of college and found that 80% of all tuition increases at public schools are because of decreasing state support, and as people have mentioned in Wisconsin and otherwise, that seems to be pretty well borne out. And in another paper, we looked at the impact of student debt on lifetime wealth, and we found that for a dual educated household coming from a public school, if they have about $50,000 in debt, which is 2 student debt burdens, leads to about $200,000 in lost wealth. It's about 2/3 of that's in retirement savings, 1/3 of that in in home equity. And so we're seeing both the impact of people borrowing and we're seeing what really effect that's going to have on the economy. And if we really want to address this crisis, we have to figure out ways to get at the root cause. That does include solutions like refinancing or other partnerships to encourage debt-free college, because if people have to keep borrowing, these kind of things are going to keep happening. Thank you.
Thank you, Mr. Hilton Smith. And I want to thank everyone who joined us for today's field hearing and for all the thoughtful and powerful comments that we heard today. They're important to us. I want to thank the audience and to everyone watching via live stream at consumerfinance.gov. This concludes the CFPB's field hearing in Milwaukee, Wisconsin, and I want everyone to have a great afternoon, and thank you again for joining us.